Welcome to Introduction to Demand Forecasting. So demand forecasting is the process of predicting future customer demand so that businesses can plan more effectively. Its purpose is to align supply with expected demand, helping companies reduce costs, avoid stockouts or overproduction, and improve overall efficiency. When done well, demand forecasting has a major impact by enabling smarter inventory management, better staffing decisions, and stronger long-term growth. So there's a couple of questions when a business has to launch a product, right? So what's the questions you ask when launching a product? So what should we do to shape and create demand for our product, which is demand planning? What should we expect demand to be given the demand in place? Demand forecasting, which is what we'll be covering. And how do we prepare for an act on demand when it materializes? Demand management. So in demand planning, there's product and packaging, promotion, pricing, and finally placing. So there's a demand shift, demand curve shift influence on forecasting, right? So if we increase the price, basically we could get more quantity demanded, as you see on the right side of the graph, right? With a discount. I'm sorry, a discount. So in demand forecasting, we have a strategic component, a tactical component, and an operational component. So in strategic aspect of forecasting, it takes years, right? So there's the purpose would be business planning, capacity planning, and investment strategies. Places like Microsoft, for example, use this with cloud demand, right? Tactical is quarterly, or it could be months to weeks, right? So in quarterly, it's brand plans, budgeting, sales planning, and manpower planning. Months to weeks, it's short-term capacity planning, inventory planning, right? And in operational, it's days to hours, transportation planning, production planning, and inventory deployment. So what to expect in every forecast? The bad news is that you have to expect it to be wrong on the first try. Aggregated forecasts are typically better, and shorter horizon forecasts are typically better, right? And that makes sense, right? I mean, just from simple day-to-day things that we look at, like the weather. Tomorrow would be probably, today would probably be the best predictor of tomorrow, right? Today would not be a good predictor of a month from now. So the shorter the horizon, typically the better the forecast. It's expected to be wrong. I mean, most linear time series models are going to have some kind of linear component, and that's definitely going to be wrong, right? We're trying to calibrate our models to reality. Unfortunately, that it doesn't pan out on our initial try. Error bands help mitigate the uncertainty. So uncertainty increases as you go further out in time, right? So going back to the weather example, today would probably be a good predictor of tomorrow, possibly a good predictor for a week from now, but from a month from now, 2 months from now, definitely a year from now, our uncertainty will increase. So expanding the confidence interval gives that room to say, hey, we're uncertain as we go out in time. You could see this kind of megaphone effect where the interval just basically increases. There's something called a coefficient of variation, which is pretty important in demand forecasting, and I'm going to go over it right now. So unlike standard deviation alone, which is affected by the magnitude of the data, the coefficient of variation expresses variability as a percentage of the mean. This allows for meaningful comparisons between data sets with different units or scales. Okay. So it's CV equals sigma divided by mu. Measuring forecast accuracy relative to the data. A high CV indicates greater relative variation, meaning the forecasted values may be highly uncertain. A low CV suggests that variability is small compared to the mean, indicating a more stable forecast. Handling seasonal and trending data. In seasonal or trending time series, absolute errors can grow over time. Since CV normalizes error relative to the mean, it helps account for this effect and provides a fairer accuracy measure. So comparing different forecasting models, CV is useful for comparing the accuracy of different models, especially when forecasting different products, markets, or industries where the absolute values of forecasts vary significantly. And we'll be seeing an example of this shortly. So I want to make a quick point. Lower standard deviation doesn't mean better. So as an example, suppose you have forecasting sales for two products. Product A, mean sales is equal to 1,000 units. Standard deviation is 50. The CV would be 5%. For product B, you've got 50 units and the standard deviation is 25, which is lower than 50, but the CV is 50%. So you can see the difference in magnitudes. The amount influences how much, how effective the CV is going to be. Even though product B has a lower absolute standard deviation, its relative variability is much higher, making its forecast less reliable. So aggregated forecasts are better. So here we're aggregating by skew, which are like soda cups, and basically got large, small, medium, and small as an example. And you can see that the small, medium, and large, they've got different CVs, right? But they've got a common soda cup lid. Now we design a common lid for all three cups, and then we see that the lower CV is 0.304, right? Aggregating by time, we could see that we aggregate on a daily time series, a weekly, and a monthly. As we go down, you could see that the coefficient of variation basically decreases. Now we're going to be talking about an example using our favorite restaurant, McDonald's. And I'll be discussing some concepts that we've discussed using examples from the McDonald's menu. So weekly French fry demand, you could see if we aggregate it, right? So individually, individually, it's 11.6% French fries for stores individually. And then we pool it with this formula, right? We use sigma mu, but this time we have to kind of control for the amount of stores with this n and a square root of n. We do some math and we do some algebra and we get 6.7%, which is for all stores, which is lower. Okay. So this is where aggregation actually helps our coefficient of variation numbers, right? Because one store, I mean, in this case, it was all perfectly uniform, but one store might be more highly variable than the other, right? So we could, when we aggregate up, it helps. So I'm going to talk about like basically aggregations from a location level, right? So we've got this store in Times Square, and it's located here on in Manhattan, basically on 7th Avenue and 45th Street, okay? Um, and like I was saying, this store could be highly variable, right? But if we go up, right, and we have multiple McDonald's, right, the aggregations help basically the variability, right? So corporate headquarters is going to look at a map like this, see a bunch of McDonald's, and they're going to want to aggregate on this level, right? Because if they aggregate on just the store level, they might be capturing what we call noise, right? Not a clear idea of how the stores are actually performing, right? Because as I mentioned earlier, one store could basically, be an outlier. It could be doing poorly one month. But if we aggregate it, we could kind of get a true picture of how McDonald's is actually doing. Then we aggregate up to New York, right? A state level, and this is going to be way better than on the city level, right? So we're going to have all the McDonald's. And then obviously, if we aggregate up to the United States or on a country level or Canada, it's going to be a lot smoother. So, I mean, the main idea, I mean, I don't want to beat this over the head too much, but main idea is that you aggregate up, you're going to get a clearer signal as to like how McDonald's is performing, right? And on their balance sheets, like in their financial statements, they're not going to corporate financial statements. They're not going to be talking about just one store, two store. Right? They're all going to be aggregations. So another point that I'd like to make is that shorter forecast horizons are more accurate, right? And I was mentioning that earlier. We see this graph here. We see that orange, I guess, bar hamburger, right? I mean, we're going to be able to predict the next month a lot better, right? We could still probably do a good job if it's like a couple of months out. But something like ice cream, for example, like it's going to be almost impossible to predict, right? Like 4 or 5 months out, right? So coefficient of variation is reduced by aggregating by skew, by aggregating by time, and by aggregating by location. Aggregation increases accuracy, right? So we're going to postpone customization, say, for example, quarter pounder, Big Mac, to close time of consumption. Risk pooling of component beef increases forecast accuracy, right? So we're going to want to, because beef is an input to producing multiple types of hamburgers, we're going to pool that, right? And I've been talking about this whole aggregation thing being way more effective, right? And just giving a concrete example. Before we were talking about lids, common lids to multiple sized soda cups. In this case, we're talking about beef and hamburgers that McDonald's produces. So cost of forecasting versus accuracy, you see kind of this graph used pretty ubiquitously. I mean, there's different versions of it in machine learning, but in this case, we're going to use it for time series. So we could say that the forecast accuracy basically increases, right, with the cost of forecasting. The more complex the model you make it, um, and the more naive it is, basically the cost of errors in the forecast it decreases as the forecast the forecast um, accuracy the forecast accuracy decreases, right? And the cost of errors basically decreases as well, okay, with the naive. And then the optimal is somewhere in the middle. So what are the key insights into forecasting accuracy for first cost, right? First, there's diminishing returns, right? Initially, as you increase the model complexity, which we saw, forecasting accuracy improves significantly with a small increase in cost. However, after a certain point, further accuracy gains require exponentially more cost. So that's going to be like more resources, GPUs, more tuning, more data. So there's a diminishing returns to like um, how much complexity you add to a model. The curve shape, the graph would likely be an exponential or power curve, steep at first and flattening out. And then simple models are cost effective but inaccurate. And we saw that decreasing error, right? Um, as the bar, as we move from the left to the right axis. And complex models are accurate but costly. So the optimal model selection, like I was discussing before, the sweet spot where cost and accuracy are balanced, is somewhere in the middle that we saw. And then beyond this point, spending more yields minimal accuracy improvements. So what determines a good forecast? Bias versus accuracy, bias versus variance accuracy. We see that the low bias, low variance circle is ideal. I mean, obviously the worst is high bias and high variance. And we're always playing this game when we tune our models to basically make it low bias and optimize for low bias and low variance. There's a business perspective to this. So how do we determine if a forecast is good from the point of view of people that are business oriented and not technical? So here's the advantages and disadvantages of under forecasting and over forecasting. I'm going to be quick. Under forecasting, the advantages is lower holding costs, lower initial capital allocation. It encourages efficiency and reduced risk of overcommitment, right? And the disadvantages is lost revenue and market share, operational strain, higher costs due to emergency measures, and reputational damage, right? Because if you don't have as many goods in stock, when you should have a certain amount that the customer wants, and there's this huge demand spike, and you're not able to fill that demand. Basically, people might not trust you. Okay, so there is a clear disadvantage to doing that, right? In over forecasting, where you're actually you're thinking that there's going to be more than necessary. It prepares for demand surges or spikes, potential for bulk discounts, so you could play that whole discount game. Enhanced customer satisfaction, more aggressive growth strategy. And then the disadvantages are higher holding and waste costs, tied up capital, increased risk of loss, and poor financial performance, right? So I mean, like if you forecast the amount of goods and you've got all this inventory, there are costs associated with that, right? Like inventory holding costs, warehouse costs, whatever it may be. So here's a couple of models that I'm going to quickly talk about. There's simple models, right? We were talking about basically that whole simplicity complexity spectrum of models, and what would be the most effective. So here, I'm putting some actual models to compare in this spectrum. So the simple models and naive models forecast same value as previous, right? I was giving that weather forecasting example where the previous day or today would be a good predictor of tomorrow. Okay. And that's, the complexity is low, the computational requirements are very low, and then the general accuracy is low. I would make the argument that it could be low or high. I mean, depending on the type of data that you're using. Um, There's moving average, exponential smoothing, linear regression. The linear regression model we saw earlier, where we just fit a linear line, which is, like I said, very simple, very simplistic. It's a first pass look basically at what could happen. But obviously, if you have nonlinear data, that's going to be an issue. Then we go into intermediate, ARIMA, SARIMA, Holt-Winters, right? ARIMA is probably the most famous model that's used. I personally used it at work as a data scientist multiple times. And the complexity is moderate, computational requirements are moderate, and then general accuracy is pretty high, right? So it consists of an autoregressive component, moving average component, and then differencing, which is basically making the series stationary, okay? Then we're going to move on to deep learning models, deep AR. You've got, recurrent neural network-based probability time series models, and these are all very high, but obviously the computational requirements are very high as well, right? So we've got the deep AR, Informer, Auto Informer, TFT, and LSTM. So those are some of the models. I mean, not all, in big companies, they've probably got a suite. I mean, I've experienced this personally. They've got a suite of like 50 or 60 models. Sometimes they're going to use ensembles as well, which are a combination of models. So what's the objective of these models, right? It's to minimize the error of the forecast. So the actual minus the forecasted value, which is generated by the model, is equal to 0. That's what we're trying to optimize for in our models, okay? And there's forecasting metrics that are tied to this, right? So the MFE, mean forecast error, we see that forecasting value, FT minus AT. And we were talking about positive MFE means overestimation, negative MFE means underestimation, okay? And that's the technical definition, but we were talking earlier about how that translates to business strategy. Then there's the mean percentage error, right? And I'm not going to go over the bullet points because it's basically a repeat of what I've just said. But you can see that the formula is a little slightly different, right? It's being, I guess, normalized by the actuals, right? And then you're multiplying it by 100, turning it into a percentage. So there's more mean absolute error, a mean squared error, right? And I would like to make the note that the mean squared error is more sensitive to outliers than the MAE. The reason being is that you're squaring the term, right? So the error will be amplified. So it's good to look at all of these metrics together because they're going to tell you slightly different things. Here's the accuracy of the last one, which is the mean absolute percentage error, and it expresses accuracy as a percentage, making it useful for comparing errors across different scales. But it can be misleading when actual values are near 0, leading to very high percentage errors. So here's an example of forecasting Big Macs. We've got actuals that are all 60, one is 95 from Monday to Friday, and then we've got forecasts. We see this graph basically, and we could see that the forecast is, it's okay, but it's still off, right? And then we could calculate all the errors from this, right? So we subtract 53 to 60 minus 7, and we do so for all of these rows. We add them up, we get the mean, right? We get the error, the absolute error, the absolute error, the error squared, the error divided by the actual, and then we can make these calculations, okay? The MFE, the MAPE, MAE, and the MSE. So So in forecasts, it's good to combine subjective and objective approaches. So like, even though you've got like really good models, statistical models that are somewhat predictive, it's good to kind of check that and also audit it, if that's a good word to use, in the sense that you check it against other measures, right? Which are some are subjective, some are objective. Subjective would be Salesforce surveys, ensemble of experts, Delphi techniques. So Salesforce survey is basically taking a sample of people and saying, okay, how much do you think this is going to sell, right? Like, and then you can get experts, and Delphi techniques I'm not going to discuss here, but that's useful as well. And then we got causal relational, which are more what data scientists tend to gravitate towards, right? So you've got econometric models, leading indicators, and input-output models, some of which we discussed. We've got experimental customer surveys, right? This is actually going to the consumer and getting their opinion. Focus group sessions, and test marketing. And then we got time series and machine learning models, another data science toolkit, which we've got black box models. I mean, neural networks, deep AR, those kind of models are a little bit black box, okay? We've got past predicts future type models, which I mentioned. And then, you identify patterns, right? I mean, we could identify patterns graphically just by simply graphing something. It doesn't have to be so much of a complex thing. And then finally, ensemble model, which I mentioned earlier, you could create multiple models from time series models, or we could use, a combination, right? I mean, we could use here, for example, ARIMA, Holt Winters together, and even a deep learning model. So something like that, right? And you see the initial forecast, which is basically a linear model, right? Right? And then you've got a recalibrated forecast. Okay. So there are parts where of the, like of the data where it could be purely linear, right? So then the linear model will be a good thing. But then if it's nonlinear, where nonlinear and linear, say there's a part that's linear, right? We would use a regression. And then something with nonlinear, we could use something more complex, like a deep learning model, right? Like a random forest. So these are, that's an important point to note, that, when we have a data point, we could use these ensembles to kind of weight how much of the data looks like it's linear and how much of the data looks nonlinear. So I was talking about subjective. We could also combine subjective forecasting methods to the objective, right? So say I'm based on customer surveys, right? So we've got an initial forecast, right? Maybe it's a nonlinear model. The orange is the actual, and then we got a recalibrated forecast, right? We try to basically reduce kind of our error, right? And we incorporate maybe assumptions from the customer survey so that we tweak our model, right? So thank you very much for those that stuck around. Here's the final key takeaways. Forecasting optimization is minimizing the error. Aggregating forecasts are more accurate. You can aggregate by time. You can aggregate by store. And you can aggregate by SKU, product. And short-term forecasts are more accurate, and combining subjective and objective approaches could lead to forecast improvements. That's it. Thank you very much. I'm sorry, one last thing. Forecastic metrics can see if forecast is biased